Okay, we are rolling after a little technical difficulties, and we are back here. Let me get into the shot so you can see me, with Dave Donahoo, who's the head of Alternatives Wealth Management Solutions at Franklin Templeton. Dave, thanks for joining us.
Well, thanks for having me, Chuck. Great to be here with you.
And thanks for the patience. We were having a little technical difficulties with the AV, but we are back with our coverage of the CAIS Summit / conference, I guess, with Dave. So we're going to be talking about alternatives. So we've been talking about alternatives for the past couple of days, but I've been really looking forward to this chat with you because you're going to give us a little look into something kind of specific, secondaries, which I'm fairly new to understanding that myself. But would you tell us what that's all about and how does that help us RIAs get our hands on these alts?
Yeah, it's a great question, Chuck. And first off, congrats on the success of the podcast and your practice as an RIA, so you know this better than anyone else. At their core, RIAs are entrepreneurs, right? They are individuals who have taken control of their practice and they are running them fully independently. And to me, what that means is you have to operate efficiently, you have to operate with scale. And sitting here at CAIS Conference, it's clear to me that a lot of RIAs are gravitating to the alternative space, but they're trying to understand how to use it. And I think organizations like CAIS with the technology revolution are making it easier to scale folks' business. But if you think about secondaries for the RIA community, I think there's a lot of similarities to that, scaling your business with secondaries. And what I mean by that is at its core, secondary private equity is the first derivative of primary private equity. What you were doing as a secondary manager is you were buying a stake in a primary private equity fund from somebody that had to sell out for a variety of reasons. It could be an institution that tripped their investor policy statements and how much they could be allocated to the asset class. It could be an organization that for one reason or another needs to fund a future commitment by selling a past commitment. So as a secondary manager, you were stepping into another investor's seat in a primary private equity fund, often at a discount. And what that creates in the secondary private equity market is a few things that I think RIAs have gravitated to. First and foremost, diversification. Secondary private equity funds are going to give you far broader diversification than primary private equity funds because you're buying stakes in a multitude of other primary PE funds. You end up owning a lot of different companies. The second part is one of the big concerns we've heard from the RIA market and the advisor market broadly is with primary private equity, you worry about the J-curve. The fact that you were spending multiple years where capital is exiting your pocket before it returns to you. Because secondary private equity managers are often stepping into primary private equity funds in year 4, 5, 6, 7 of their life. They're stepping in right at the time when distributions are about to return. So RIAs have gravitated to the asset class, especially those that are looking to scale alternative exposure for their clients, because it's a way to do so in a highly diversified way. It's a way to do so where capital comes back to you quicker, and it's also a way to do so where because of the discount in which you're buying the assets at, you're often operating with a bit of a tailwind. And so we've seen a lot of interest from the RIA community gravitating to secondary private equity. I think the audio stayed on. Do we still have video?
Yeah, we did. So
we're back.
We got the video and a real good close-up of my bald spot. So this is we kind of go for the Blair Witch thing here on goRIA.
I've always been told I had a voice for radio, but here we are.
So yeah, I'm looking at some of these other setups with a little bit of AV envy here, but you know what? We love our little handhelds and everything else, so we are good. And we are still rolling.
Perfect.
We'll add to some of the levity of this particular conversation, which is an important one. Okay, so a lot of good stuff there that I would like to unpack. So these secondaries, that's an interesting way to look at it. So it's essentially a fund, right, made up of pieces of other funds, which are made up of other companies. So that's a heck of a lot of diversification. Yep.
Heck of a lot of diversification. You will typically end up with a secondary private equity fund owning thousands of underlying companies. And so one way to think about it is you're getting to paint the landscape of the private equity market. You are getting diversification by sector, by geography, by type of private equity across buyout, growth, and venture, and really importantly by vintage year, right? So you're buying interest in funds that were launched, for instance, today in 2021, 2020, 2019, 2018, so on and so forth. So if you're an RIA that is scaling exposure to the private equity market, and you're trying to do so in the primary private equity arena, you have to be very programmatic for your clients year in and year out to scale your exposure. But in the secondary market, you can do it quicker. You can do it in a way where often capital is returning to your client quicker, and you can do it in a highly diversified way, which we think, all else being equal, creates a consistency to a return stream that has really resonated with the RIA community.
Yeah, no, I like that a lot. And so for our shop, Sovereign, we tend to be a mass affluent shop. So the idea of diversification when you're going into what could be a scary asset class, like private equity, is kind of new for a lot of our clients.
Unknown.
Absolutely. Having that diversification of having thousands of positions within that one ticket, it has a lot of appeal to us, for sure.
We're seeing that across the RIA landscape, and that's really exciting trend for us.
Let's pivot a little bit to liquidity. How does liquidity work on something like this?
Yep. So if you think about liquidity in the secondary private equity market versus the primary private equity market, there's a few lenses I would look at that through. One is if you're investing in a drawdown fund, an 8, 10, 12-year lockup drawdown fund, where you have capital calls to get your money in and you're waiting for distributions to return to you. Generally speaking, you're going to get your capital in quicker to a secondary private equity fund, and you're also going to see capital return back to you quicker. We think of that as mitigating the J-curve. So that's a really positive aspect of secondary private equity that's attracted RIAs. The other way I would look at it is, what is the realization activity in the secondary market versus the primary private equity market? And today, we're seeing this with capital markets. Capital markets, given interest rates and a lot of other factors, have been at the lower end of their activity level for the last decade, right? You're not seeing as many IPOs, et cetera, et cetera. But in the secondary private equity market, there's multiple exit activities or exit ramps that are available, right, for the primary PE managers whose funds you're buying a stake in, whether it's an IPO or a sale to a strategic or a sale to another private equity firm. And historically speaking, as an asset class for secondary private equity, in any given year, about 10 to 25%, round numbers, of the portfolio companies that are owned in a secondary private equity fund are going to be realized, right? They're going to be sold and that capital will be returned back. So if you think about it through that lens, you're getting your money in quicker, you're generally getting your money back quicker, and you're doing it in a highly diversified way. I think folks have found that attractive.
Yeah, I think that's a nice way. And again, I keep going back to the mass affluent. This is not necessarily just for the mass affluent, but it seems like it's really well made for the mass affluent, especially that first-time investor into this particular space. Are you seeing a lot of flows from those types of folks?
So we are seeing interest and activity there. That gets into a bit of vehicle structure and accreditation, et cetera, et cetera. But one of the things that RIAs, and you know this well, running a business, have struggled with private markets and alternatives generally, is historically the way to access them was institutional 8, 10, 12-year lockup funds, right? What we call drawdown funds. And you have typically a high accreditation status on those, qualified purchasers, where an individual has to have a certain net worth. You typically have a limited shot clock to do your diligence and invest in those funds. You think about it from the RIA's perspective, the entrepreneur. That means if I only have 3, 6, 9 months to diligence a fund, but I have hundreds of underlying clients, if I'm investing in these funds over 1, 3, 5 years, I end up with a spattering of different funds that I have to monitor and report on. So a lot of what you're seeing now, led by organizations like CAIS, helping from the technology side, and asset managers on the product revolution side, is development of semi-liquid or perpetual strategies. And we've done that in this space as well. And what that does is it lowers the accreditation standard. More folks can invest. It makes the minimums to invest lower. You can be more responsible with your asset allocation. It allows the RIA to think about things they would have thought about with traditional markets, dollar cost averaging in, dollar cost averaging out. And it creates a really scalable and efficient solution for the RIA, but also for the client as well. And we see a large trend there that we think will only accelerate.
Okay, that sounds good. So let's get a little more granular, and I'm going to take advantage of the fact that I have you here and do a little due diligence for my shop, Sovereign Financial. Right, as you can tell, I'm not a professional AV guy, as we've seen here today.
Better than me.
Yes, indeed, perhaps. But I do run a shop, and we are very interested in alts. Yep. So your structure, is it interval fund or tender offer fund? Can you speak to that a little bit?
Sure. So we've selected a structure that is tender offer in nature. And I think what that means, and is really important for folks to understand, is an interval fund guarantees a level of liquidity. A tender fund gives an expectation of providing a level of liquidity. And we think different asset classes for different reasons belong in different structures. Philosophically, this is the way the Alternative by Franklin Templeton business thinks about any asset class that we're going to bring from an institutional drawdown structure to an evergreen or perpetual structure. The first part, and this is paramount to us, if we feel like a different vehicle structure is in any way, shape, or form going to dilute the investment integrity that has made the manager we own and partner with in that space successful for decades working with institutions, we're not going to do it, right? So we spend a lot of time and effort making sure whatever vehicle structure we build doesn't degrade the secret sauce of the manager that we partner with to build that structure. If we feel we can do it, the next thing we do is we think about what's the right vehicle structure to deliver operational alpha to the client base. And what I mean by that is easiest and most efficient to use, differentiated from what's in the market, aligned to the investment capabilities that we have, and that structure working with that, whether it's frequency of liquidity in, frequency of liquidity out, leverage caps, etc. So we get very into the weeds once we decide we can build a structure, because we think we can run the capital in that structure the same way we have for decades, into what's the right structure for our client base.
Okay, that's exactly where I was hoping you would go with this, because I think that's important, especially for those in the audience that are new to these types of investments. And I'm a big believer in this, and I love the alt space, really do. But clients need to understand the idea of liquidity, right? And a private equity fund, I think, in my opinion, should be tender offer, right? And to really highlight,
we agree.
Yeah, to highlight what
a lot of interviews today, all good,
is the following, and this really is an important point. So for those of you that are new to this, you have interval funds and tender offer funds, and you just said this, but I really want to highlight this. So interval is, I am giving you 5% liquidity a quarter, kind of period, full stop. Tender offer is, we're looking for that, may not happen sometimes, we might have to gate it. And I think that's the right thing to do for private equity. I mean, you can't just sell part of a company like that just to get liquidity. And I think what you were getting at, and tell me if I'm wrong on this, there are certain funds out there, which I disagree with this philosophy, that they're watering down their offering to give you that liquidity, but then it's not really a private offering anymore if 20% is liquid stuff, yeah?
I think at the end of the day, we think about our business as we want to be a scaled solutions provider to the RIA market and to our clients. But we don't want scale at all costs. We want to do it responsibly, and we want to do it the right way. And the reality, and you know this well, the best way to scale your business is to deliver for clients what they expect you to deliver to them. And so from our perspective, you're spot on. We think very deliberately and thoughtfully about what's the asset class we're building a vehicle structure for, what's the liquidity of that underlying asset class, how can we honor that liquidity in an evergreen structure that you could choose to let people in as frequently as daily, let people out as frequently as monthly. We've not done that, right? We have a vehicle structure that will let folks in monthly, let folks out quarterly. We feel that's aligned to the asset class, and that's strategically important to us, because the reality is, while you may be able to market yourselves in a different way if you make the ins and outs more accessible, we're thinking long term. And we want to build a business that's sustainable and does the right thing for our clients long term, and we think this is the right structure to do it in.
Okay, and I completely agree with all of that, because I think that's one of the caveats when you're coming to these private investments is understanding that liquidity, right? And especially for those new investors in that mass affluent market, they need to understand that this is not a daily liquid fund. And I think it's incumbent upon us advisors to make that clear. And I think it's incumbent upon the product producers like yourselves to make the right ones in the right vehicles. So I really commend you guys for that, because I think a tender offer is the way to go with the equity. I think interval could work more for private credit because it's generating some income, so you have some built-in liquidity there, yeah?
We have a multitude of evergreen funds in market as an organization, and we're fortunate enough at Franklin Templeton to work with an excellent private real estate firm, Clarion Partners, an excellent private credit firm, Beneficiary Partners, and Lexington Partners in secondary private equity. And the way we've set it up is the exact way you just described. In private credit, we offer an interval structure. In private real estate, we offer a tender structure. In private equity, a tender structure as well. And that's aligning the liquidity of the underlying asset to the liquidity for the client, and that's incumbent on us and the RIA, and I know you do this well, Chuck, to educate your clients, right? And we've built a whole institute around this, the Franklin Templeton Academy, that does non-product specific education. What, where, when, how to use alternatives. And the reality is, for most individuals, alternatives shouldn't be a 50% allocation. It should be higher than it is today because of what it does for your portfolio in our mind. But we work with RAs to make sure they responsibly size it the right way and they understand the liquidity constraints of what they're investing in.
Okay, real good. So that's probably a great place to put a pin in it for today in this segment. And Dave Donahoo, thanks so much for joining us on this.
Thanks for having me,
great
Chuck.
Information,
it's great to be here.
And you're a good sport about some of the AV glitches, so thank you so much for that.
All good.
And thanks for joining us for this segment of goRIA, fueled by Investment News. We have one more left, and we're going to close it out with someone from CAIS to give us a recap of today's and yesterday's events. So stay tuned for that. Dave, thanks again.
I'm excited to hear it.
All right, real good.